from its final international peg with gold in 1971. Although the West shares many common economic principles with the East, as the capitalist banking systems are similar, there is one area where there is a clear distinction. This is how Easterners view the role of gold as money. Western governments fear gold. It restricts their ability to create currency. In the West, governments borrow and encourage their constituents to follow their example. Banks encourage us to borrow from everything from vacations to widescreen televisions made in China. They tell us we're stimulating the economy through consumption. Generally speaking, the investing public in the West sees gold as a wealth-gaining asset to be traded like stocks and bonds. This is why Westerners are constantly fretting about the gold price in currency terms. The Chinese government, on the other hand, respects gold. This is evident by the laws they have passed to facilitate mining and private gold ownership. China currently leads the world in gold production. The government encourages the public to put 5% of their savings, yes, they encourage savings, into gold. This is significant because the Chinese can save up to 40% of their annual salary. In the West, most middle-class families are lucky to break even. The Chinese see gold as a wealth-preserving asset that will weather all seasons. This is the difference, I believe, anyone who wishes to fully understand gold's rising price must comprehend. Inhabitants of older countries who have lived through the destruction of an inflation-fueled currency crisis do not need to be reminded that gold is the most effective hedge against inflation and a currency crisis. Former CEO of Newmont, Pierre Lassonde, also feels that it will be buying by the Chinese public that will eventually propel gold prices into the stratosphere. Clearly, the three medium-term trends we noted last year are still firmly in place. Now I'd like to take a look at three longer, irreversible trends that I believe will affect the price of gold and currencies for decades. These are the aging population, outsourcing, and peak oil. The aging population is a combination of a population that is living longer and the pig and the python effect of a huge tidal wave of baby boomers born between 1946 and 1963 who are just starting to enter retirement age. As people age, they spend less and downsize. GDP and tax revenues are reduced, and a much smaller workforce follows the baby boomers, so this is a triple whammy. This problem is universal. In China, it is further exacerbated by their one-child-per-couple policy, and governments will have no choice but to create more currency and further debase it. Outsourcing has almost entirely destroyed the manufacturing sectors of many first-world countries like the US, Canada, and much of Europe. The Chinese worker who built your iPhone made $287 a month. This was after a well-publicized raise. The West simply can no longer compete with these labor costs. The United States was the world's largest manufacturer after World War II and has driven the world's economy ever since. However, the U.S. consumer can no longer buy things as they lose their jobs. As factories move offshore, the high unemployment becomes systemic. Without jobs, the GDP and the tax revenues of the U.S. will fall. The mountain of federal, state, and municipal debt will become even harder to service, and the government will be forced to go even deeper in debt and to further debase its currency. The final point is peak oil, which is at the maximum rate of global petroleum extraction is reached, after which the rate of production enters terminal decline. This has already happened in the U.S., Alaska, and the North Sea. The next few years, Mexico will become an importer of oil, and the U.S. will lose its third largest supplier. Our fragile, highly indebted economy relies on this land-based cheap oil to continue, and it cannot withstand the shock of transitioning to more expensive alternatives. In September of 2010, a German military think tank reported that the German government is taking the threat of peak oil seriously and preparing accordingly. Numerous studies around the world have concluded that we're very close to peak oil production, which will be accelerated due to the Gulf drilling bans. This will also lead to higher price inflation for most goods, and this will be a blow to the fragile U.S. economy, which currently pays less for oil and gas than any of the first world countries. When added to the effects of the waning strength of the petrodollar, the results will be devastating. May I remind you that if China, which currently has 1/10 the number of cars per capita as Americans, was to reach par with the United States, we would need, by one estimate, 7 more Saudi Arabias just to meet their needs. Now, these three megatrends, when put together, will continue to lower the GDP, lower the tax revenue, create higher trade deficit, create higher unemployment, and result in the need for further currency creation. This will cause inflation to rise as currencies depreciate in value and create higher universal debt. All this means is that the gold price will continue to rise. Finally, as a direct result of worldwide debt and currency debasement, more people will be competing for the world's available gold. We discussed peak oil, but gold is also reaching a peak as fewer and fewer new deposits are being found. Smaller, lower-grade deposits with none of the economies of scale benefits of larger deposits are being put into production out of desperation. Mine supply has been in decline since the year 2000. As safe haven demand accelerates, there will be a transition from the approximately 200 trillion of financial assets to about 3 trillion of above-ground gold bullion. Of the 3 trillion of above-ground gold bullion, about half is owned by central banks and half is privately held. The privately held gold is largely held by the world's richest families and is not for sale at any price. The central banks are now net buyers. If the world's pension funds and hedge funds moved only 5% of their assets into gold, which these days would seem quite conservative, gold would trade above $5,000 an ounce. So in conclusion, I will say that without any new financial crisis, both mid-term and long-term trends are in place to ensure gold and silver will continue rising through 2011 and well beyond. For those of you who are looking for a prediction, last year at the Empire Club I forecasted the price of gold to be between $1,300 and $1,500 at the end of 2010. We ended up right in the middle at $1,405. For 2011, I recently forecast it may climb to between $1,700 to $2,000 per ounce. And that's just based on the last 5 years' performance and the factors I have presented today. I encourage you to follow the example of those who know how devastating a currency crisis can be and buy gold to protect wealth and not treat it as a speculation. I'd like to close with a quotation that seems to put all of this into perspective. It comes from Norm Franz's appropriately titled book, Money and Wealth in the New Millennium. He said, "Gold is the money of kings, silver is the money of gentlemen, barter is the money of peasants, but debt is the money of slaves." Thank you.